Welcome to Opening Bid. I'm Yahoo Finance Executive Editor Brian Sozzi. Now let's, make a lot of money and get a lot smarter. But before we do that, I have to start thinking about the stock market in September. I don't know where August has gone. It's gone by very fast. It started off with stocks getting flushed right down the toilet, but it's ending a lot better than it started. But I'm here to at least bring up some key stats for September before you get all excited. You're probably excited about NVIDIA earnings and AI. So let me be that Debbie Downer or wet blanket. So some good stats by Bank of America on September seasonality. So what Bank of America did, they went back to 1928. That's clearly before I was born, and looked at how the S&P 500 performed going back to 1928. I love stuff like this. They found September has the weakest seasonality of all 12 months of the year, with the S&P 500 only up 44% of the time, with an average return of negative 1.2%. In other words, historically, going back to 1928, the stock market or the S&P 500 has been down. This performance tends to get just a little bit worse during presidential election year. September, going back to 1928, in an election year, S&P 500 down. Also down in October. I told you, I'm like Johnny Wet Blanket here. I have nothing good to tell you about. I will leave you on this too, because I was looking for something upbeat and optimistic to bring you here on September, but don't really have it, which might mean the stocks end up finishing up for September. But whatever it is, the first 10 days of September, historically going back to 1928, stocks are down. In the last 10 days, stocks are down in September, historically going back to September 28, more so in the last 10 days than the first 10 days. So apologies in advance for not bringing you any good news on September for stocks. But maybe we could bring you some good news here with our next guest here, and we'll talk some stocks. We'll dive deep into the markets. Raymond James, CIO, Larry Adam is in the Opening Bid house. Larry, good to see you. I'm sure you've heard my depressing intro and on how September may or may not unfold for the stock market. I mean, should investors even buy into data like this? It's good that we're crunching these numbers. We're going back to 1928 before any of us were on the planet or even a thought or a twinkle in anybody's eyes. But I mean, what does this data even matter, or we need to throw it out and look at what's really coming at us in September? And maybe there's some positive things people don't even realize.
Well, I'll take both sides. So first of all, I do think that seasonal sometimes can be misguided. You know, for how many times do we talk about sell them in, go away during the summer? And if you look once again this summer, we're going to end up being up somewhere around 6-7% between Memorial Day and Labor Day, right? So you got to be careful with those seasonals. Now, that being said, I do think that this upcoming September could be a little bit more volatile. Yeah, if you look at our year-end forecast, we're looking for 5,400 for the S&P 500. That tends to be our guiding light. As we sit here today, as you mentioned, we're above that. So we are looking for some increased volatility, some softness here. And the one thing I would add to your stat is that when you do tend to have an open election, meaning two non-incumbents running, between today and election day, historically, we've been down on average around 3%, and it's been down about 70% of the time. Again, not a major pullback, probably a buying opportunity, but it does set up some headwinds here for the market in the near term.
It's been an interesting August for investors. Of course, came out of the block. Stocks were selling off. Japanese yen carry trade. Most people had no clue what that even meant, but they were just saying because everybody else was saying it and it sounded cool at the time. But August has really ended pretty well for stocks. Why is that the case?
Well, the market tends to move in extreme ways, right? So beginning of August, think about what happened. We had a weak employment number, and all of a sudden we had this growth concern that the economy was going to implode and that the Fed wasn't going to necessarily cut interest rates. Well, since then, you've seen the fact that, sure, our economy is slowing, but it's not collapsing. And as you saw last week at Jackson Hole, it does look as if the Fed is ready to start to cut interest rates, which will likely start to support this economy for the remainder of this year. And that's pretty much our base case. We think we're going to actually get a soft landing. We're not going to have anything that's going to be severe where it all of a sudden causes, earnings to implode or the economy to implode where we see massive layoffs. But we just think we're going to see a digestion period here for the economy. And then ultimately we'll start to recover once we get into next year.
When stocks are blowing up like they were, Larry, in early August, what is your day like?
The phone doesn't stop ringing for sure. But I think the biggest thing that we always tell people is don't panic, right? I mean, you've seen all the studies. I'm sure you've had them on your show. Is that oftentimes when people make decisions based on emotions, they get in and out the wrong times and they miss the typical big bounce, right? So if you would have gotten out when the market was down at its lows 9% in those days that you were talking about, well, we're almost back up to record highs again. You would have missed out on that. And I think that that's important. Probably one of the biggest things that I do in many ways, act like a psychologist, right? Telling people not to worry about it, that oftentimes the market gets a narrative and it overreacts in one direction or the other. And then just to sit back, let it unfold. And as long as we have our fundamental analysis intact, make sure we're positioned for the correct way. And we think that ultimately the equity markets continue to move higher into next year.
Are people yelling at you on the phone? Like, how does that work? No, I mean, a lot of people don't have your position. I mean, what are those, like, somebody calls you up and their stock is getting hammered 10, 15%. They now understand why. I mean, these can't be pleasant conversations.
No, but I think, again, once again, you put it into perspective, right? A lot of these companies have been up 30, 40, 50% over the last 2 years. And I think when you start to put that into perspective with people, they start to appreciate that. And then we talk about some of the names that you're talking about that saw some of the biggest sell-offs, some of the tech companies. Let's think about the fact that they have been up significantly, but they have also been up for the right reasons, right? And if you look at their earnings growth, earnings has been a big driver of them. And then I tend to talk to them about the fact that, you hear in the press that these companies are all of a sudden really expensive. And I walk through the analysis with people that if you look at the numbers, the PE as of today, it may look expensive on paper because that's based on the earnings estimates as of today. But if you look back historically, the tech sector is the one area where you consistently see beats significantly and consistently. And on average, it's somewhere around 7 or 8%. So once you start to factor in those beats over time going forward, all of a sudden those valuations aren't as expensive as they are today. So those are a lot of the conversations that we go to. We still want to be in areas, companies that are high quality, that tend to have good earnings. They're in the sectors that we like. And obviously I do like the technology sector. I like the industrial sector. I like the healthcare sector. And there's still some really good names that have a lot of good earnings visibility going forward.
I know I'm going to get this question. What am I drinking? Because I've gotten this before. It is an energy drink. I know it's yellow. It kind of looks like some weird, strange soda. But I'm not going to mention the company's name because they're not paying for an ad on opening bid. So we'll leave it there. But Larry, you mentioned soft landing. How do you define a soft landing?
So our definition of a soft landing is that you're not going to see negative GDP growth. In fact, if you look at our GDP forecast for the third and fourth quarter of this year, we think GDP is going to go down to around 1%. Job growth is going to slow, potentially slightly below 100,000, but not go negative. And that just sets up a cooling period where the economy can kind of reset itself. And then we'll start to see it once again get closer to that 2% plus type of GDP growth next year.
Why? You've seen the markets, I think, cheer, and I think you brought this up, Larry, the prospect of rate cuts from the Fed. But there isn't the other side of this. If the Fed is going to start cutting rates in the fall, doesn't that mean the economy is slowing down faster than they would have thought, and that stocks are not priced for that?
So I always tell people that it doesn't matter. Everybody will ask me, how many times do I think the Fed has to cut? 1, 2, 3, 4, 5, whatever, right? I'm less concerned with the number of cuts. I'm more concerned about the ultimate impact to the economy. And I think what's really important this go around is that the Fed is cutting because it can, not because it has to cut, right? And if you think about it, a lot of times the Fed has had to cut. When we had COVID and the economy was rolling over, when we had the great financial crisis where they had to cut rates to increase the liquidity of the market, right? That's not really where we are right now. The Fed is in many ways almost taking a proactive approach by cutting rates before we see those significant declines in the economy. And I think that is what's very important this time around, right? Because if the economy were to roll over and we were to see negative GDP growth where the economy was contracting, absolutely. That would be a negative, not only for the economy, but then for earnings growth. And that would be a negative for the equity market. But we don't see that happening. We still think that you're going to see positive earnings growth for the equity markets next year, around 10% or so. And that'll keep the tailwind in the sales of the equity market to continue to see them move higher into next year.
I think you'd be really, I think you're the right person to ask on this, given your perch at Raymond James. What happens to savers when the Fed starts to go on this rate cutting cycle? Because as you know, savers they've plowed into low risk assets, CDs, money market accounts, you name it. They've been earning a good sum of returns for essentially doing nothing. What happens to that crowd when rates are cut and they're not earning those same rates?
Well, I think, again, once again, you got to put it into perspective. First of all, you're absolutely correct. And I would say not only investors, but many of the biggest companies that have had significant amount of cash on their balance sheets have had a very nice run here as you're talking about money market accounts having returns of north of 5%. So one of the things that we've been talking about to clients is that there's no need to rush, but over time, as the Fed is cutting rates, you want to start to transition into longer duration bonds where you can get those higher returns for a longer period of time. Again, there's no rush because even if the Fed were to cut what we believe 2 times this year, that probably brings those money market account rates to just below 5%. That's still a pretty healthy return for not taking on a lot of risk, as you mentioned. But as we start to progress, I think you want to start to look for other areas of opportunities in the market and extend your duration, particularly in the fixed income space. By the way, I think that's another reason why, we are pretty, we remain optimistic on the equity markets because, to your point, when I do think that those rates start to come down, the opportunity cost of not being in other asset classes like the equity market will grow larger, and that'll start to bring some more money back into the equity markets longer term.
All right, hang with us, Larry. We're going to go off for a quick break. We will be right back on Opening Bid. All right, welcome back to Opening Bid. We're having a great conversation here with Raymond James, CIO Larry Adam. Larry, you were just talking about the impact of savers moving money out of these lower risk assets, money market accounts, CDs, you name it. How much of a tailwind do you think that could be to the equities markets?
Well, first of all, I really haven't seen it happen yet. As you mentioned, if you look at money market accounts, it's now well over $6 trillion. It's like $6.25 trillion, right? So I do think that over time, it could find its way into the equity markets, and it will be a support, particularly if we see pullbacks in the equity market. And that's why we don't think you're going to see a significant decline in the equity markets where you get back into a bear market status where it's down 15-20%, because I do think that there's plenty of cash on the sidelines that could come in and has been waiting for an opportunity to get into these various companies and sectors that we've been talking about that continue to provide long-term opportunities in the market.
What's the appetite when you talk to clients to put money to work should Vice President Harris win the White House? Because whatever side one falls on, the only thing we're really hearing from that side of the camp is higher taxes, potential taxes on capital gains or unrealized gains. Those things can't be bullish for stocks, no?
No, I mean, they're the 2 biggest risks that we have in front of us, depending on either candidate. If you talk about if President Trump is elected, obviously tariffs could be a big problem. And the one problem why it could be an issue is because, remember, a president can do that on his own, right? So those tariffs could come, and our economists have done a lot of analysis. And if you were to put all of them into effect, it could be almost around $2,000 per household. So that's one
real
thing
money.
We have to take.
That's real money for households that are still trying to get over inflation.
Absolutely. And again, that's their maximum amount, but it is something that could be a big impact and a drag on the economy. On the other side, as you mentioned, the tax cuts from 2017 will expire at the end of this year. So even if Harris gets elected and there's still a Republican Senate, well, guess what? If they can't come to an agreement, they expire, to your point, right? And as you know, that's somewhere around close to $5 trillion over the next 10 years, which can be meaningful, right? It's something that we have to keep an eye on. Both of them have had what they call strategically ambiguity around their policies, but it is something that we talk to all the time with our political analyst, Ed Mills, right? To sharpen our pencils as we get close. Right now, it's a little bit too early to do that. I would also tell you that one of the biggest mistakes I believe that investors make is trying to alter their portfolios based on who is going to win. And I'll just give you 2 quick examples. That when President Trump was elected, what sector did everybody tell you had to be in? It was energy, right? Mm-hmm. Drill, baby, drill. Well, guess what? If you went over his 4-year term, energy was the worst performing sector by a wide margin. What sector did everybody tell you to avoid when President Trump came into office? It was technology. And guess what? Technology ended up being the best performing sector. Fast forward to President Biden, the sector that everybody told you to avoid, energy, renewable, the Green New Deal. Well, guess what? Energy by far and away is the best performing sector so far under the Biden administration. The sector that everybody told you to get into, consumer discretionary because of universal income, all the spending. Guess what? That is the worst performing sector. So my point is that if you were to look at our equity framework that we look at, we have 10 different factors. Politics ranks number 8 in importance. There's far more important things like how's the economy, earnings growth, valuations, sentiment, what the Fed's doing. Those by far and away are going to dictate where the equity markets go than who was sitting in the White House.
Larry, indulge me for a second. Let me just go down this path because I do want to talk some more about stocks, but indulge me here. Let's say I am a high net worth client, and look, I aspire to be, and I belong to Raymond James. I have $150 million. That's my net worth. I own 7 houses, a bunch of cars, and all sorts of assets. And a new president comes in and says they want to tax unrealized gains on all of my wealth. What do you tell them? How do they pay for things that they still own or using? Are you getting questions like this now?
We do, and we think that that's a low probability that gets passed because of what you just said. That's pretty hard to mark the market every single year for your taxes. So I think that that's a low probability of being done. You know, you also talked about illiquid assets, houses and other things. Like, how do you mark them to market every year, right? That's almost like if you look at one of the problems that we already have when it comes to inflation. One of the ways that they determine shelter inflation is they call people like you and me on the phone and they say, how much can you rent your house for? Well, again, we may be financially savvy, but that's not like a number that we keep in our back pocket, right? Mm-hmm. Those things are pretty hard, and you start putting biases of what you think it's worth versus the reality. That becomes a very difficult equation to really put into place. So could taxes go higher on capital gains that are realized? Yes, particularly if she is elected. But I don't think this unrealized thing is going to have much momentum because it is a very onerous process to come up with those numbers.
Hey, I don't want to sell my $50 million mansion, Larry. I mean, don't take it away from me. It took me so long to get it. No, I'm just kidding. I actually don't own a $50 million mansion. I'm just trying to get by. So talk to me about some of the sectors that you like. I read your recent note. You sound, I don't know, I will say down a bit on consumer discretionary names. Why is that?
Well, I just think the consumer is very challenged right now. If you look at what's happening, consumers are pushing back on price increases. So these consumer discretionary companies really don't have the pricing power. If you listen to a lot of their earnings calls, they're focusing on volumes as opposed to price increases. And in an economy that is softening and slowing, at least here for the next 2 quarters, that's a pretty difficult type of situation to be in. In fact, I would tell you, believe it or not, during the second quarter earnings season, if you X out Amazon, the rest of consumer discretionary had earnings growth of 0.5%, basically flat, right? And that was during an economy that was still growing around 2.8%, right? So think about when it slows, the impact that it could happen. So we continue to focus more on areas where businesses are spending because they tend to be a little bit more freer right now, trying to figure out ways to grow their businesses than focusing on the consumer. And that's why you see the focus on technology, industrials, and healthcare.
How does Raymond James, or how do you define consumer discretionary? Is Disney, vacation plays, are they consumer discretionary, and you think maybe those stocks are overvalued?
Well, technically, that Disney's not in the consumer discretionary bucket, but I would consider it a consumer discretionary company, and one that I would have a little bit more caution in those companies that spend in those types of areas. Disney's going to be found in more of the communication services part of the index, and they're going to be more reliant on the other parts of their business to help drive their earnings, right? More of their streaming type of activities.
Is every tech play, do you view it as some form of AI play, or how do you decide who is truly going to benefit from this megatrend?
So we do look. So I think that AI is in its early stages. And the reason I say that is because a lot of the spending that is being done right now is really just building the foundation for what ultimately is going to happen. I think the next level up, and you're going to start to see it come out right now, is with the hardware and the software enhancements that are going to be used, right? And then the next step is going to be companies actually using those softwares to drive their efficiencies. So we think this is a very long runway from which AI is going to continue to drive that particular sector. I think what's important, one of the questions I get from a lot of clients, and it's an interesting one, is, I use AI and sometimes it doesn't give me the right answer. That just tells you that it needs to get bigger and it needs to get faster. So how do you get at it? You need more data, right? It's a data-driven system. So that means that you need to get more data put into it, and you're going to need to get more the software looking at it and trying to interpret it much better. So I still think we're in the early stages of that taking place.
What slows these stocks down? I don't see it, Larry. I mean, to your point, this is like a trend that's going to be playing out for the next 10, 20, 30 years. How do you spot when some AI play is overvalued? Because to me, it doesn't seem like traditional ways of valuing companies, discounted free cash flow, looking at P multiples forward and then versus historical averages. It doesn't seem like these things are working like they used to.
Yeah. So one of the reasons why we like technology is if you just look at the earnings, three things came up. As you mentioned, they had great earnings. What are they doing with their earnings? They are buying back their stock. They are increasing their dividends. And they are investing in the future to make sure that they can maintain their very robust margins. And I think that's probably the most critical part of it, that they continue to reinvest to make sure the technology that they have continues to be demanded by both businesses and consumers. And I know there's a lot of doubters out there when it comes to technology, and that this has been a more short-term rally that we've seen and it can't really last. But believe it or not, if you go back and look over the last 10 years, the average annualized performance of the tech space is over 22%, right? So it has been a consistent driver. And I think that that's one of the things that the technology revolution that takes place continues to feed on itself. And a lot of it's because of those bigger companies continue to drive the R&D to make sure that these new technologies continue to be additive to what you and I do on a daily basis.
Thank you for really just calming my nerves about me selling my hypothetical $50 million mansion. We appreciate it. Larry, Adam, good to see you as always.
It's always a pleasure. Thank you.
All right, thanks. And that's it for the latest episode of Opening Bid.